so kind of the topic is empowering entrepreneurs, and I'll explain kind of what that means, in the context of this private company market. How many people here, I guess, had heard of SecondMarket, prior to tonight? So I guess great, most everybody. Now, I think kind of the cool thing about what we're doing is this whole private company market, it really is new for us. Been around for almost 5 years now. So I'm going to kind of go through. Oh, if I can do that. Okay. So I'm going to, first, can we move the? Down? Great. Kind of go through a number of topics, but first, who the hell am I? So I started SecondMarket in 2004. Like most startups, we had a different name. Business was, original idea was pretty much what we're doing now, but we started off as called Restricted Stock Partners. I was formerly an investment banker, so I am a recovering investment banker. Any of the former bankers in the room? Yeah, so it's happy to be away from that world. But I did restructuring and bankruptcy work for about 5.5 years, and went to school down in Atlanta at Emory. Just did undergrad, and I'm also now a new angel investor. I guess you can call that dumb money, maybe, but I'm doing a bunch of deals, doing kind of platform marketplace type deals. So that's me. So what I'm going to cover tonight, first is a little bit of history about SecondMarket, where we kind of came from. Going to give you some of the inside scoop on financings and revenue and all that stuff. Going to talk a bit about the IPO market, kind of what's happening and what's wrong with it and what's wrong with being a public company now. Going to dive into this whole private company market, kind of what's happening, some of the trends we're seeing. Then I'm going to attack some of the myths, a lot of myths out there about this private company market. And lastly, if you are not completely convinced by the time I get there, I'm going to try to explain why I think this is a really, really great thing for everybody here. So this is our history. So this company was started off kind of when I was an investment banker. I was working on these big restructuring bankruptcy deals, and I was responsible for selling off a lot of these illiquid assets for these companies like Enron and WorldCom and companies like that. And I was like, why is this process so completely inefficient? Everything's so manual. There's got to be a better way. And bankers and all of Wall Street is really not all about innovation. But I said, why is there no eBay for kind of selling all these illiquid assets? So I put together this really cool business plan. It was like, I'm a banker, so I put together like a 100-page business plan. And sorry about that. No problem. Anything good? So it had lots of charts and graphs, and showed us kind of taking over the world. And the idea was I was going to go raise like $3 or $4 million and go build this whiz-bang platform to create this market. And so I showed this business plan to a bunch of people at the bank at Houlihan where I was working, and I said, good idea, but terrible idea for execution. Instead of going out there and raising $5 million and building this whiz-bang platform, just start doing transactions. And so what you'll see from our history, when we started, I raised about $400,000. But when we launched in 2005, it was 5 of us and a few telephones and an Excel spreadsheet. And that was our marketplace. But because we launched that way, we were actually, believe it or not, profitable from the first year we launched. And so in 2005, we started on just one asset class, and it's called restricted securities down here on the bottom. And really what that is just like stuff that restricted stock in public companies, stuff you can't sell publicly, but we created a market for it. Great business, million revenue in 05, 2.5 in 06. And we realized that we were onto something. Wasn't really sure what, but we thought we were onto something with this marketplace idea. In the summer of 07, we were approached by First Smart Capital in New York. It used to be called Pequot Ventures. They said, okay, we love what you guys are doing, but you're like way too low tech. Let's scale this business and let's get involved in more asset classes. And so we raised about $3.8 million from First Mark at like a $15, $16 million pre-money valuation. And the idea was, okay, let's expand SecondMarket beyond just this first asset class. So we kind of saw the writing on the walls with a bunch of the crap that was out out on that Wall Street pushed out, like these toxic assets. And we said, okay, we're going to be there when this whole thing kind of comes crumbling down. And we were there. So the first asset class that completely exploded was something called auction rate securities. Big disaster, like $330 billion of this flawed product was sold. So we created a market for that. Then we got involved in bankruptcy claims, got involved in limited partnership interests, got involved in mortgage-backed securities, like the really kind of toxic crap, and created a really good business around it. So we did $20 million in revenue in 08, and profitable business. And then we started getting involved in the private company space. And I'll talk about that in a second. Eventually, we did raise money, Series B, from Li Kai-shing out of Hong Kong and Temasek out of Singapore. We did that earlier this year. They put in $15 million at 135 pre. OK, so the private company market, it's interesting how we got involved here. As you would probably not be surprised, it was Facebook. So in like late 07, early 08, we got a phone call from a former employee, couple of Facebook, who said, hey, I got some options, I just exercised them. I don't have any money. I want to go start a company or do something else. Can you help me out? And at the time, and from the last chart, you remember, we were only doing like other asset classes, not private company stock. And we said, okay, well, Facebook, cool company, even then, growing fast, certainly well known. Let's see if we can find some buyers. And we did. And it was interesting because we didn't have to do a lot of work to get some competitive bids, but there were buyers for Facebook. And then before we knew it, we had like $100 million of stock in a bunch of really kind of cool tech companies like eHarmony and Slide, saying, hey, we want to sell our stock. So we kind of took a step back and said, okay, what's going on here? I mean, why are people wanting to sell their stock in these really exciting backed companies, venture-backed companies? And so we spent about a year really just meeting with venture capital firms and lawyers and entrepreneurs, saying, okay, what's going on here? Like, what's happening in the industry? And we came to some pretty interesting conclusions. I'm going to take a step back. Why do companies go public? There's really kind of 4 reasons why companies go public. One is because they need to get liquidity to their shareholders. Next is they need to raise capital. Next is for currency to make acquisitions and to pay employees. And lastly, for branding. And what we learned is the public markets are broken. Does anybody know what high frequency trading is? Okay, someone explain kind of what it is? Anybody want to take a, come on, someone say, what's high frequency trading? Ben?
Explain to you when you have computers that are really near to the NASDAQ or the core computers at the marketplace, and they're just a tiny bit faster than everyone else. So when the marketplace aggregates shares, you're able to come in, see the build of demand, and buy ahead of everybody else, and make a tiny bit of profit off of that.
Exactly. So does anybody know what % of our public markets trading activity is being done by high frequency traders right now? Anybody want to guess?
7, 8, or 9.
Okay, so the estimates are as high as 75% right now. And 10 years ago, it was like 5%. So think about that for a second. What that means is that computers are the ones that are buying and selling the vast majority of stock in the public markets. So we've gotten completely away from mutual funds and real kind of longer term investors. So when you have something like that, you have something called a flash crash. Who was watching TV on May 6th? Anybody here? Okay, so this was really fucked up because what happened in the course of literally 10 minutes, the stock market dropped like 1,000 points. And no one knew what was going on. And some of the bellwether stocks were trading like a penny. It was like crazy. No one knew what was going on. And they still don't know really, but what people think happened is that because all the volume was coming from these high frequency traders, when the machines went haywire, all the liquidity in the market just completely dried up. So what happened is as people were trying to sell stock, there was nobody left to kind of buy this stock. So that's one example of why the markets are broken. But there's more. Sarbanes-Oxley. This was put into place a few years ago, kind of in the wake of some of the accounting frauds or scandals. Basically what it is a public company, you have to spend a bunch more money paying accountants and lawyers to basically be compliant, and it's like a few $1 million a year. That sucks. Short sellers. As a public company, you have to deal with short sellers pounding your stock, making up rumors, and having to deal with that as a public company management team. Next, there's no more research for smaller companies. All the research is now focused on really kind of the top 10% of the companies. And it's exacerbated the problem because there's no more brokers. I know brokers got a really bad name, but back in like the 70s and 80s, everybody here would have had a broker, and they would have been advising you on stocks to buy. Now everything is being done electronically. And so what's happening right now is there's no one out there kind of pushing smaller cap companies that people haven't heard of. But the worst part is the average holding period in the public market, so this is when you buy stock, has gone from 5 years in 1970 down to less than a year right now. So think about that for a second. So pretend you're a public company CEO and you're, building a business and you've got your management team kind of coming up with great plans for the next 2, 3, 4 years. Well, you know what? The average person buying your stock, they don't give a shit. They don't care. They just want to make sure that you are meeting or beating earnings estimates for the next 2 quarters. So I think that that's broken. And I think this is the ultimate sign of the apocalypse upon us. Can you guys see who this is? Who is this?
Jersey Shore.
Jersey Shore. Okay, this is the cast of the Jersey Shore ringing the bell in the New York Stock Exchange. I'm sorry, I mean, who's got a gun? So as a result of all of those dynamics, the average time now to going public has gone from 5 years on average over the past couple of decades to almost 10 years. Almost 10 years. I mean, think about that for a second. So when you invest in a company or you join a company and you get options or get some stock, you have to wait 9 years to get liquidity. Obviously, that's a problem. But wait, you have an M&A exit, right? That's a good alternative. All right, well, there's certainly downsides there as well. So here you sell your company to Google. So the first thing that happens is you lose control. Next thing happens is if you maintain control, the vision for your company is completely bastardized. And then ultimately, you and everybody leaves. So yeah, maybe you got some liquidity, but for anybody here who wants to kind of build a long-lasting company, this is not the way to go. So this has resulted in a big, big exit chasm that exists in our public markets. And I think a lot of people have not made the connection between this exit problem with the effect that it's going to have on our country. So without an exit, we're going to lose the angel investors. So angel investors, whether they're super angels or regular angels or folks like me, the dumb money, we're not going to stay in this market if we have to wait 10 years to get liquidity. Then we're not going to be able to create companies to create jobs, build long-lasting businesses, and then it's going to result in no more innovation. So as a country, it's going to affect us competitively, and we're going to be losing more and more jobs to really, really exciting, fast-growing companies overseas. So what does this all mean? The existing capital formation process, I don't know if you've kind of heard this term before. What this typically has meant was, okay, what is the process for, as a startup company, kind of raising capital and getting to an exit? So this is how it's looked up until now. You found your company, you'd get some angel money, some seed money, you do a few rounds of venture, and in like 5 years or so, you would typically have the option of doing an IPO or an M&A exit. But now, it's 10 years. So what's happened is there's been this gap that's formed that kind of needs to come into years, call it like 5 to 8, 5 to 10. And that's where we think the private company market is going to come into play. So, when we set out about 18 months ago to kind of create this, this new market structure, I think what we realized was we're on a bit of a crusade here. Because, this is certainly, we're not the first ones to ever think of doing this. And a lot of people have not, I think, kind of made the connection between the lack of exits and the effect it's going to have on our country. So we've kind of, SecondMarket, we've kind of gone out there and been meeting with companies, getting people excited about this. But what we realized was the solution is not another NASDAQ or another New York Stock Exchange. We had to take a completely kind of new view about what it would take to kind of create a better market model for private companies. So one of the first things that we noticed was, in the past, going from a private to a public company was kind of like, it was like a light switch. You went from being overnight private to public. So you went from having little regulatory oversight and little liquidity, and you didn't really have much experience kind of dealing with public investors, to all of a sudden kind of being kind of thrust in the limelight. And the problem is that if you could even get out as an IPO, you had the risk of becoming one of these like zombie public companies. And you guys probably know what these are. These are the companies that they basically don't trade anymore. They're kind of like trade like 5,000 shares a day, and you don't have any liquidity, and the valuation sucks. And it's kind of like public company purgatory. Like once you're there, you're stuck, and you can never kind of go back. And the problem is that it's really hard to predict, even if you get out there, which companies are going to become kind of the flourishing, kind of very liquid public companies, and which ones are going to end up being one of these zombie public companies. So our approach is, it should be more of a dial. So the way we look at it is, instead of going from private to public kind of as a light switch, over time, the company should slowly become more public in terms of disclosure, in terms of trading, in terms of the types of investors that they have involved. So this is what we've set out to do over the past 18 months. And yeah, I think we're just getting started, but I think the volumes speak for themselves. So you can see over the past 3 years almost, where we've seen a lot of the activity. And yeah, I mentioned start off as Facebook. So in 2008, we did about $30 million in transactions in Facebook and 2 other companies. In 2009, about $100 million in Zynga, LinkedIn, Facebook, and 6 other companies. And already this year, we're at $260 million. So in total, we've now done about $400 million in transactions across 40 companies. And I think that's pretty exciting, because if you think about that $400 million, the vast majority of it, it's not going back to venture capital firms. It's going to employees, former employees, management teams. And I know that that money is being recycled back into the system. So before I hit the myths, any questions about what we're doing so far? Yeah, please.
If the money's going back into the system, where does the money going into those people's pockets come from, and how is that different from the money that's going back into the system?
What we've found over the past year is that there's a tremendous amount of capital that wants to get involved in these companies and these companies. They just never had access before. So what's happening right now is we're seeing mutual funds that are now starting to kind of cross over from being public investors to private investors. We're seeing like sovereign wealth funds getting involved in the private company space. And one of the cool developments that we've seen recently are funds are now getting formed to invest specifically in private company stock, where they can kind of pool a bunch of individuals together to buy Facebook or buy kind of social media type stock. So what's happening is that it's not old money from the industry that was kind of sloshing around. It's new money. It's billions of dollars of new money coming into this market.